All right, how's it going, friends and family? My name is Amos, and I'm going to say something very controversial right now, and I might offend some feelings, so you might want to put some earmuffs on, but 99% of the people out here, you have no business picking, choosing, selecting, and investing into individual stocks. For most of y'all, you're better off with ETFs. Now, an ETF is kind of like buying into one stock that opens up the door to a dozen or even 1,000 stocks in one. And they all have different strategies, so it's entirely impossible to find one that you cannot nod your double chin head with. You're gonna find one that you align with, that you agree with, that you like, and you're attracted to. Now, I'm personally not an ETF kind of guy because I'm absolutely delusional, I'm stupid, and I believe that I can beat the market year after year by picking individual stocks. Now, if you want to hear my articulated thoughts as to why, then watch the video that's going to be linked right here. But having said that, I still think ETFs are absolutely fantastic. I like them, I love them, and they make a ton of sense. Okay, I'm not a hater. Now, this is part one in a 4-part series on the best ETF combos. And today we're gonna be kicking things off by looking at some of the easiest set it and forget it portfolios that can basically run on autopilot for the working years of your life. Some people also refer to this as the wealth accumulation phase of our life stage, and that's because we're able to contribute more of our active income, our W-2 or 1099, whatever it is. If you're an Uber driver, if you take off your clothes for OnlyFans, you can contribute more of your paycheck towards your investments, and especially towards your brokerage account, whether it's in Roth IRA or an individual taxable brokerage account. Now, I hear you. You might be like, why 4 parts? Does it really take that many videos to express what the best ETF combo is? Yes, because the best ETF combo, it really depends on your age, your goals, and your priorities in life, and especially your risk tolerance. Because what works for Billy in the Philippines, it's not going to work for Jacob, that's a car salesman in Detroit, Michigan. Does that make sense? Now, I want to throw this disclaimer out there because it seems like everybody preaches growth and only growth if you're in the wealth accumulation phase of your life. I fundamentally disagree with that because when you look at the data, dividend-paying stocks, they outperform and they have less volatility over the long run. And based on risk tolerance, dividend-paying companies, not always, but a majority of the time, like Pareto's principle, like 80% of the dividend-paying companies, they usually tend to have stable and mature fundamentals. So if you think I sound biased when I give you my ETF combos that I like, then keep in mind that I'm a dividends kind of guy. I mean, look at the freaking channel name and the handle, Amos the Dividend Guy. So my take on this is going to involve dividends. Because if we're going to be honest with one another, most people, they don't have the stomach to invest into all or nothing growth stocks that could potentially 10x or go belly up. Like, you think you have that kind of risk tolerance until you lose 10 grand, 50 grand, 100 grand, when your investment goes from $100 per share down to like $6 per share. You really think you're gonna be all in into growth stocks then? Right? So with that, the first combination is going to be a good blend of growth, but also dividends. And that's going to be SCHG, QQQI, and it could be either or IBIT or hold, which is essentially going to give you some Bitcoin exposure. So the first one that I want to take a look at is SCHG. I feel like their cousin that lives in West Virginia is a little more popular, SCHD, but SCHG is an ETF where the constituents follow the Dow Jones US Large Cap Index. So if we jump on over to the holdings tab, it's full of popular blue chip players. And the average PE ratio of all their holdings, 197, the PE ratio is a 39. So they're mostly trading for a premium, and that's because they're being priced in for growth. So 11% of the portfolio of the ETF is NVIDIA. We got Microsoft at just shy of 10%, Apple, Broadcom, Amazon, Tesla, Meta, Google, Eli Lilly, Visa, and the list goes on and on. These are all very popular growth stocks. That would be my pick number one. If we jump on over to the dividend tab, the dividend yield, absolutely nothing to write home about. You can't retire off of a 0.36% dividend yield. I hear you. The dividend growth rate, though, kind of pretty. A 5% growth rate. It's higher than the historical rate of inflation, which I like to see. And we're going to be taking a closer look at their stock market performance here in a little bit, but let's introduce the other ones, right? His teammates. The next one is QQQI, and it's the NEOS NASDAQ 100 Income ETF. Essentially, it's a call option strategy on the NASDAQ 100 index. And with this one, you get a little bit of share price appreciation, but more importantly, a very juicy monthly dividend. So if you look at their holdings, it's going to be a little different from SCHG because not only do they hold the NASDAQ 100 stocks, but they also have call options, I think all the way at the bottom. If I scroll down, I can show it to you. Oh, like right there, right? Option on NASDAQ 100. And basically the NASDAQ 100 is an index that's kind of different from the S&P 500. That's also referred to as the broad market, the benchmark, the standard. With the NASDAQ 100, it skews heavy towards the tech space. But unlike the S&P 500, absolutely no financials are going to be represented. So the NASDAQ 100 has about 51% of its companies operating in the tech space. The next biggest category would be comm services at 12%, consumer discretionary 11.7%. But if you take a look at it, there's no financials. If I jump on over to the S&P 500, like, I don't know, VU, and I show you their sector breakdown, it'll look entirely different. Technology is 33%, but the next biggest chunk of change is financials at 12%. So the NASDAQ 100 is an index that should be aligned with most people that are in their working years and investing, if you're not eyeballing retirement. And the last one that I want to talk about is IBIT. This is going to give you exposure to the Bitcoin movement. Now, I know I said we're going to be taking a look at their performance here in a little bit, but this one, let me get ahead of myself. Let me show you their max performance. They've only been listed since January of 2024. You'd be up by 124%. You would have 2x your money in roughly 2 years. Now, if this ETF, IBIT, or even its cousin, hold, it's going to follow the performance of Bitcoin, and it's that growth that you don't want to miss out on, right? I think going 100% into equities, for me, it makes sense, but now that I've been researching and doing my homework into cryptocurrency and everything, it's like, okay, I think it makes a ton of sense. Just like IBIT, hold is also around like 126% into the green. The reason why I picked IBIT over hold, like if all else were equal, is because the assets under management. With hold, we're talking about $2 billion. But with IBIT, we're talking about almost $90 billion assets under management. So all else being equal, I usually go with the one that has a bigger portfolio, and it's also ran by BlackRock, if that helps at all. And the reason why I think it would behoove of you to look into Bitcoin is because if we just scroll back, 5 years, it's up by 1,133%. I'm so sorry. I live in Japan, and that's why the currency has a very wacko number. If we were to convert it to US dollars, it would also be 1,100%. If we max it out, bird's eye point of view, just look at that, right? Do you want to miss out on the continued growth of Bitcoin? That's a question. You got to look in the mirror after taking a cold shower and your wiener is all shriveled up and say yes or no. Do you want to miss out? It really depends, right? For some of us, we're completely okay sleeping at night knowing we're not a part of the Bitcoin movement. And for others, it's like, okay, I want to be a part of this train ride, okay? No matter what dip, they always seem to find a way to go back up to an all-time high. For crying out loud, I remember when I was getting my MBA, some of my classmates were like, dude, go into Bitcoin, get into it. And I was like, dude, Bitcoin, that stuff sounds like a scam. And back then, this is Japanese yen. It was like 406,000 yen. So I was like, dude, I just think it's too expensive. Oh, really, Amos? Because now we're talking about, 16.9 million yen. So had I invested into Bitcoin back in like 2018, 2019, I would have been a happy camper, but I did not. However, it's never too late to reverse course and to change my direction and to implement a little bit of Bitcoin. So if I were to follow my own advice, I would definitely look into IBIT and hold. Now, having said that, now let's go ahead and take a look at the performance of the 3 ETFs that I'm talking about would be the trifecta, the perfect combination. To kick things off with Bitcoin itself, 34,750% total return. That's absolutely bonkers, right? Let's jump on back over to SCHG and talk about and look at what are their numbers. So right now I'm on a website called financecharts.com. We're just going to be looking at their adjusted stock price total return. So for the past 1 year, SCHG, 24% into the green. If we zoom out 5 years, 129%. Do you think it gets better? I'm going to tell you right now, it gets better. Did you look at their top 10 constituents? NVIDIA, Microsoft, Apple. Of course it's going to get better. 10 years out, you would have 5x your money with SCHG. If we just do the total history since 2009 of December, 1,063%. SCHG. And if I scroll down and I show you a comparison to, I don't know, the S&P 500, commonly referred to by their ETF SPY, in the exact same time period, past 15 years, their CAGR, their compound annual growth rate, how much would your money have grown on an annualized level? With SCHG, we're talking about 17%. With the S&P 500, 14%. If we want to look at it 10 years, SCHG is 18%, S&P 500, 14.6%. No matter how you look at it or spin it, SCHG just outperforms the market, the standard. However, the tables turn and they change if you compare it to the QQQ. Then, of course, the NASDAQ 100 does beat out SCHG. But that's why I'm saying QQQI, because not only do you get a little bit of that share price appreciation from the performance of the NASDAQ 100, but you also get a juicy freaking dividend. So for the past 1 year for the QQQI, you get a 21.8% total return. That bakes in the dividends plus the share price appreciation. Now, their stock market history is not that long. I think it only goes back to February 2024, but since that timeline, 38.8% when you include their share price appreciation plus the dividends paid out. And you might be like, why not just the QQQ? Because we're going to be talking about that for the next ETF combo in this video. And I think the next natural question is, okay, but what does this look like in a realistic portfolio? I think we're taking a look at the numbers from a distance, but what would it look like in my own portfolio? So making the assumption that you invested about 10 grand into each one of these ETFs, and you just stopped contributing and putting more money into it, and we're just working with the initial 10 grand when they became listed on the stock market, like publicly traded, then what would have happened? So as you can see on your screen right now, is this big enough? Let me zoom in. Maybe, okay, is that better? I don't want you to pull out your reading glasses. I'm trying to help you out, okay? I got your back. So $30,000 invested, 33% across the board, SCHG, QQQI, and IBIT. The valuation of it right now, $135,000. That means your portfolio, the share price appreciation would have grown $105,000. Are you freaking kidding me? No, seriously, are you kidding me? And just as a reminder, in case you weren't paying attention, we're not contributing any more money into this portfolio. It was just marinating and growing on its own. Like you put it into the oven, that Thanksgiving turkey, and you forgot to pull it out, but magically it's still delicious and not overly dry. I think one of the worst things about Thanksgiving turkey is when you overcook it and it becomes so freaking dry. No amount of cranberry sauce or gravy can save it. At that point, you might as well turn it into like a turkey pot pie or some kind of stew. But anyways, 16.2% growth rate of your money year over year. I think that's simply amazing. Now, obviously, I think the one that's doing the most heavy lifting in this team would be SCHG, but that's also because they had the most timeline on the stock market. I think these two are probably on the same timeline. And just to save you the hassle of opening up a new tab to see when SCHG became listed, it was around like 2009. It was December 10th, 2009. And for IBIT, it was January 12th, 2024. And for QQQI, we're talking about February the 2nd, 2024. As you can see, $10,000 here, $10,000 there, $10,000 here. Do you see the power and the magic of allowing your portfolio to do the work for you, to allow itself to marinate and to compound over the years? Even if you choose not to put any more money into it, I mean, wouldn't you be pretty happy with 30 grand turning into $135,000? I mean, that's almost enough to buy a small condo in the middle of nowhere, Arkansas or Alabama. Obviously, with $135,000, you can't buy a house anywhere else, but maybe in the middle of nowhere, you'd be a happy camper. You might even make a little pond and go fishing every other day. And I wanted to expand upon my thoughts on why this exact combination as being my ideal ETF portfolio for the working man. And that's because it has all of the right traits. Not only do you get an excellent CAGR every single year, I mean, sometimes it might be down if the overall market is experiencing red, everything is bleeding, this is not going to be immune. They're also going to be in the red. But friends and family, historically, on average, economic downturns in the stock market only last like 9 to 15 months. 15 months, absolutely catastrophic, but on average, closer to 9 months. So if you can just weather out the storm, put on your little parka that's waterproof that you bought on Amazon for like 20 bucks, but it leaks through the armpits. If you just weather out the storm, you'll be okay. I mean, the proof is in the pudding. But regardless, not only do you get a good CAGR, you're also going to get a juicy and a beautiful dividend income to help you to reinvest back into the portfolio to buy more shares. Now with Snowball, I don't think it shows you the dividends reinvested. So you're literally just pocketing those dividends. And what you see is just represented by the share price appreciation. I guarantee if there was a way to have the dividends reinvested throughout the ages of when I invested that 10 grand into each one of the ETFs, it would be a higher number. So with this combination of ETFs right here, you're investing into the best of the best big companies. I mean, like 9% of your portfolio would be allocated towards NVIDIA, Microsoft, Apple, Amazon, Broadcom. These terms want to say you don't need to do any legwork, any research, any sweat equity to figure out, oh man, what should I invest into? The ETFs do that for you. And if anything changes with one of their holdings, they just kick them out and replace them with someone else that's prettier, that smells better, that seems to shower at least every day because they're sweaty. And if you can't tell, I am a Bitcoin bull. So with this portfolio, you would also get some sweet cheese, that Swiss cheese, that Parmesan, that mozzarella from Bitcoin as it continues to go to the moon year after year. Now, obviously, there are some dips, there are some sell-offs, there are some valleys, but historically, Bitcoin just seems to find a way to go to a new all-time high. Now, I do want to make it a point that this is probably not the most aggressive ETF combo that's going to get you the pound-for-pound best total return, but I don't know about you, but I'm okay with sacrificing some gains and leaving it on the table if I know that I'm going with a coherent strategy that's going to yield a slow and steady output, a result that's inherently a little safer. Now, obviously, we could just torque this lever all the way to the 10 out of 10 risk scale and put it into other ETFs that might be more aggressive, but I think this is a good blend, a good mix, growth, but also dividends. And that's because I don't really look at the stock market as a casino. I know some of us out here, the expectations are so freaking high. Like you need to 10x your money by next week, or you're calling this thing a scam and it's stupid. But for those of us that have spent some time in the stock market, you realize that's a losing game. You're basically gambling your money. So instead, I like to look at the stock market as a patient man's game. With enough time, in due time, with high quality investments, your money will compound. That's not financial advice. That's just what the historical data shows us. I mean, as you can see on your screen right now, for the past 1 year, we would have beat the S&P 500 by 7.6%. Right there. This is what I'm looking at right there. So in the past 1 year, the portfolio's total return was 27.6%. And if we compare that to the S&P 500, he's talking about 18%. So it does outperform the market while also giving you a very juicy dividend yield. So in my opinion, now I could be wrong, I think this ETF combination is darn near perfect. It has some blemishes, yes. Like we can alter the adjustments of the allocations. Like for some of us, we might feel more comfortable going with 50% SEHG. And then for IBIT or hold, maybe like 5%, 10%. You can fine tune the settings to whatever your liking is. But for me, I think 33% across the board is a pretty healthy blend. Now, having said that, let's move on to the second ETF combination. It's very similar to this one, but a different flavor. And that combination is going to be the QQQ, which is the Invesco's NASDAQ 100 Index Fund ETF. Look at the holdings. It should look exactly like QQQI, except this one, they don't do a call options strategy. So instead, it just follows the index pound for pound. So their performance in terms of the share price appreciation is going to be much higher and better than QQQI. But you're not going to get a juicy dividend. And as a matter of fact, if I jump on over to the dividend profile, a 0.46% dividend yield, and the dividend growth rate shrank 6.6% year over year. But if we're going to be honest, you don't invest into the QQQ for their dividend. No one does. You invest into it for their growth. And that's because it has exposure to NVIDIA, Microsoft, Apple, Broadcom, just like QQQI. And its teammate, the other 50%, in my opinion, would be dividend growth. Ticker symbol DGRO. This is also owned by BlackRock, and it's a dividend growth ETF that some people would argue is better than SCHD. I don't really agree with that, but it's an ETF that follows the Morningstar US Dividend Growth Index, which means their portfolio holdings are going to be companies that are in that Morningstar Dividend Growth Index. Average PE is a 20. Number one is going to be Apple, and then we have Johnson & Johnson, Microsoft, ExxonMobil. Kind of looks like the S&P 500 to me. Jump on over to the dividend tab. The dividend yield is 2%. The dividend growth rate is 0.33%. As a matter of fact, I'm going to do an executive decision right now. We're going to alter this ETF combination. So instead of going with DGRO, I'm so sorry, guys. We're going to have to go with the tried and true. I think for this ETF combination, it should be QQQ, which should give you exposure to the tech AI boom, but also a dividend growth ETF that's higher than 0.33%. So SCHD. Their dividend yield, 3.8%. Their dividend growth rate, 5.8%. Now that sounds a little better, doesn't it? And if you scroll on down and look at it visually depicted, their dividend payout, this is every 3 months or every quarter. It just goes up and to the right almost every single year. It's consistently and reliably growing. So I don't know. I know there's a lot of fanboys and a lot of people that love DGRO, but pound for pound, I still think SCHD is better. Now, obviously, if you take a look at their holdings, they have a huge exposure right now to the oil and gas field that is suffering. 19% of SCHD is allocated towards oil and gas, but also 19% of it is allocated towards the old school traditional dividend paying stocks like Procter & Gamble, Pepsi, Coca-Cola that are also suffering right now. And that's why if you take a look at SCHD's performance only in recent times, it's not pretty, okay? Past 1 year, negative 4.4%. I hear you. But if you zoom out and take a look at it on a max scale, you would have 3x your money, only taking into account the share price appreciation, which I don't think it's a fair way to assess SCHD, because you do in fact have to bake in their dividends, because it is, after all, a dividend growth index. Dude, how are you going to tell me that DGRO is a dividend growth index when the dividend is hardly growing? Year over year, 0.33%. Actually, I want to look at it visually to see what the heck is going on. Okay, so it seems like there was something funky going on with the data, because it does in fact look like their dividends are growing at a very juicy rate year over year. So I don't know why it's suggesting a 0.33%. And that's why it's always helpful to benchmark your data and look at another set to see if it makes sense. And for me, I think the tiebreaker is going to be Seeking Alpha. And they're insinuating that I start a premium trial for the next 7 days. And to that, friends and family, we say no thank you. We scroll on down and take a look at their actual growth rate of 6.8% year over year for the past 5 years. Okay, so maybe I was being a little harsh based on the misinterpreted numbers that were portrayed on my screen by stock analysis. I just go off of what I see. So maybe we can continue with QQQ and DGRO as this ETF combination. I'm so sorry, but I still like SCHD. But having said that, I'm genuinely curious about who actually comes out ahead when you take a look at their total return, because after all, this is the wealth accumulation portfolio. You want your money to be compounding, right? So DGRO, and let's compare it to SCHD. I have a bad feeling that DGRO is going to smack SCHD in the face, because for the past 1 to 2 years, their strategy of picking up the oil and gas has just been biting them in the left booty cheek. Hopefully it's a temporary thing, because over the long run, their strategy, it did seem to work. Past 1 year, obviously DGRO, you come out ahead, 11.6%. And if we zoom out 5 years, then DGRO still comes out ahead. Ooh, friends and family, this is not looking good. And even if we do 10 years, DGRO still comes out ahead. This is what I'm looking at when I'm saying that. For DGRO, your total return, taking into account the dividends paid out plus the share price appreciation, is 232%. Whereas with SCHD, you would have 3x your money, 200%, right? If we do 15 years, DGRO does not go that far back. So if we just look at the past 10 years, then I guess in a numbers performance manner, then DGRO is the better ETF, but that's only because of recent history. If you take a look at it up until like 2024, if we were to alter the timeline and only look at it up until January 15, 2024, then SCHD was the clear winner with 165% total return in 10 years, or roughly like 9 years, and with DGRO, 151%. But their strategies are completely different, and as of right now, I think DGRO's strategy is more sound and is better. I mean, objectively, as an investor of SCHD, I have to admit it. Going balls deep into oil and gas right now it was not the correct move. Now, I know why they did it, because the index that they follow went balls deep into it, because their dividend profiles are pretty juicy in the energy sector. So I don't know. We'll see what happens. Maybe the rotation back into oil and gas will happen once the interest rates come down. We don't know, right? If we look at it holistically with the real timeline, then friends and family, DGRO is better than SCHD. But if I were to make an educated guess, I don't know what's going to happen, okay? I'm not going to pretend like I have a genie in my left nipple. I don't. But in the next 10, 20, 30 years, I think SCHD will outperform DGRO, but the data suggests otherwise because of the recent shift in their strategy. DGRO decided to go all in into the top holdings of the S&P 500, whereas with SCHD, they're picking up the ones that are just being beaten up right now because of the high interest rate environment. So it really depends. And I'll give you one more ETF combination because we're almost at that holiday season. Dude, I'm so excited. I'm stoked. Thanksgiving, Christmas is absolutely my vibes. So this next ETF combination is going to be very different from the first two that we just talked about, because this one is if you're indifferent to dividends and you don't really care, but you just want your portfolio to match that of the market, I don't think it gets any better than this. This ETF combination is going to be VTI, 50% of your money into that, and VGT. So it might even be very similar to your 401k, TSP, or whatever you're investing into, your workplace-sponsored brokerage account. Having said that, predicated upon putting $10,000 into VGT and VTI near their IPO date and then not putting any more money into this portfolio, I think it yields a pretty amazing result. I mean, your invested capital is $20,038. The internal rate of return, which is how much your money would have grown year over year, 13.9%. And I'm so sorry, because where are my freaking manners? The reason why I'm saying it's a parallel to your 401k or your TSP is because with VTI, you're essentially investing into almost every single publicly traded company in the US. VTI stands for the Vanguard Total Stock Market ETF. No, they're not going to have exposure to China, Brazil, India, but you're investing into the United States of America. 3,526 different stocks are represented in VTI. I think that's pretty crazy. So by investing into VTI, you're literally investing into every single company in the US. So when someone makes a video talking about this, when someone says, hey, did you see this? You're already invested into it. You don't like pharmaceuticals? Well, too bad, you're invested into it. You don't like tobacco stocks, sin stocks? Well, too bad, you're invested into it with VTI. Okay? And his teammate is going to be VGT. That's the Vanguard Information Technology ETF. It says IT, but it's essentially all of the AI players. What I mean by that is 17% is NVIDIA, 13% is Apple, 13% is Microsoft. As you can see, these are the heavy hitters when it comes to the hyperscalers and the AI and the cloud movement. So 50% into VGT, 50% into VTI. I think this is a really solid set and forget if you don't really care about dividends. Why am I saying that? Because if we jump on over to the dividends tab, you ain't gonna be too happy with the dividends that are paid out from this. And that's because you invest into VGT for their performance. You don't invest into them for their dividends. And something that you want to keep in mind is when you think about VTI, they've been around since July of 2001. So that's when the initial 10 grand was invested into VTI for the portfolio that we're going to be looking at here in a second. And if we do the exact same thing with VGT, they've also been around for a hot minute. So let's see, January of 2004. So when you think about it, that portfolio, they would have experienced the 2008 to 2009 Great Recession, the pandemic sell-off, and every other catastrophic event that happened in the past 2 decades. You got to keep that in mind. It wasn't just a rosy time. It wasn't just rainbows and sunshines and unicorns pissing gold glitter everywhere. No, VGT and VTI experienced all of the storms, all of the speed bumps. And that's why over the grand scheme of things, over the long run, by investing into the stock market, you'll come out ahead. As long as you're not investing into speculative crap or stupid companies that aren't even profitable. If you're doing that, then you might lose your money. If we're talking about VTI, SCHG, VGT, QQQI, you'll be all right. Actually, more than all right. Now, having said that, the initial 20 grand, it would have transformed into $297,000 in almost, what would you say, 25 to 30 years, depending on if you're talking about VGT or VTI. The 10 grand into VTI would have turned into $143,000. And for VGT, that 10 grand would now be $153,000. So I think this is pretty remarkable. And I still think for the wealth accumulation phase for me, I would go with 50% into VTI, 50% into VGT. Now, this is for the person that does not care about dividends. Me personally, this is not my cup of tea. I would rather go with the previous 2 ETF combinations. I mean, we could substitute DGRO for SCHD as the counterpart to the QQQ, but I feel like those 2 strategies, those 2 combinations are more of my cup of tea rather than this one, but this one is also pretty good if you don't want to deal with dividends and you don't care about dividends. And the next topic that I want to talk about is, in true set it and forget it for the hands-off investor, I mean, what about the frequency of contributions, right? Because today I think we took a look at the example of an initial 10 grand, not putting any more money into your portfolio, not reinvesting the dividends and then watching it grow just by the share price appreciation and pocketing all the dividends. But for most of us, that's not the case. I think we like to contribute and put away more money into our portfolios. That way it can compound and snowball faster and at a bigger rate. I mean, that sounds pretty dirty, but you know what I'm trying to say. Personally, I'm not telling anyone else what to do. I'll just tell you what I do. I do dollar cost averaging. I'm a firm believer of chipping away and putting a little bit in here and there on a scheduled basis, especially on red days. As you can see on your screen right now, this past trading day, October 24th, what emotion fueled the stock market? It was fear, right? It's 33 out of 100. You want to see it somewhere around a 45 to a 55. We're at a 33. That means there were more people selling stocks than buying stocks. And that's why a lot of the heavy hitters were probably in the red. Actually, we can verify that. So it looks like besides the Mag 7 and the tech stocks, almost everybody on the right-hand side of their screen, deep into the red. Tesla, negative 3.4%. Almost everybody else was red or pretty much end of the day flat. The Mag 7, still looking good. And the financials made a small rebound. That's good to see. But anyways, as I was saying, to dollar cost average, put a little bit of your money into your portfolio or to buy more stocks on red days. This is what a red day hypothetically would look like. You leave your emotions out of it and you buy when the fear is high, such as like right now, and you buy when there is greed as well. Just a little bit, not as much, because to buy on red days is my name in the game. I don't really like to buy when everybody else is greedy, when everything is at an all-time high. I'm willing to wait on the sidelines patiently. And as I wait on the sidelines, I wanted to address this. You might have noticed that none of the ETF combinations have any bonds represented. And that's because personally, I'm not a fan of bonds. If you want to get a 3 or 4% income yield, I prefer and I would rather just put my cash into a high yield savings account or into a money market fund. And then when the opportunity arises, you can take that cash out that's highly liquid and then to the dollar cost average into whatever it is that you believe in. Now, having said that, I will tell you, I'm absolutely a hypocrite because I don't follow what I just said because personally, I'll be honest with you, dude, I do time the market, okay? I only buy into stocks when they're below their intrinsic valuation. So, case in point, if a stock that I'm eyeballing and I'd like is like $150 and they're trading for like 151, 152, I don't care about the hype. I don't care about the momentum. I'm not putting my money into it. However, if I know their intrinsic valuation is 150 and they're trading for like $92, $91, That's when I like to buy into. I do time when I buy the stocks. I guess I don't time the market in a broad sense because I'm always investing. But when it comes to buying stocks and ETFs, I only buy when the opportunity makes sense. I don't like to buy when it's too expensive because when there's a pullback or a sell-off, then I'm in the red, if that makes sense. I only like to buy as they hit their little valleys and dips. But still, for most people, I think being systematic and dollar cost averaging, whatever your methodology is, like every Friday, every Monday, or every 2 weeks when your paycheck hits your bank account, I think that would be the best course of action. Now, obviously, that's not financial advice. I think that just makes sense, right? That's common sense. Just a dollar cost average whenever your schedule says it's the right time to do so. Now, I do want to emphasize and do make this a point. I think when it comes to the frequency of contributions into a portfolio, a hypothetical investment or whatever, I think the only wrong answer here, day trading. Buying today with the scope and the lens and the strategy of selling tomorrow once it rallies to like 4% or whatever number you're eyeballing. I just feel like, dude, that's like the quickest way to lose my money, right? I think about what Peter Lynch said. I think it might be Warren Buffett or Charlie Munger. I can't remember. One of the super investors. When you're eyeballing a stock, don't even think about buying into it as a business owner if you don't plan on riding with it for the next 5, 10, 15 years. You need to think about things with a long-term horizon and a perspective. Don't just try to win a battle. You got to win the war. Does that make sense? So for me and my portfolio decisions, I think 80 to 85% of the time, I think about it with that type of mindset. I think there are times when I do buy into a stock that went on an unjustified, unreasonable, and emotional sell-off of like a 40, 50% dip overnight. And I see it, I'm like, all right, I'm gonna buy into it and then sell it once it rebounds. There are times for that as well. In general, I do not think day trading is tactically sound. It's not healthy and it's not good. Because like, I might win once or twice in a row and then I'll be like, dude, I know what I'm doing. Eventually, I will get burned by doing day trading. I think for me, long-term investing is the better way to go. That way, you're not clenching your butthole because you just put $100,000 into the speculative biotech stock and you're waiting for it to go up, or it could also go belly up, right? So I don't know. It's better to buy into fundamentally sound, cash flow heavy, beautiful compounders that have a dividend profile that would make your grandma happy. I would rather do that than to take a gambling casino style risk with day trading. So I don't know. And before I get out of here, I wanted to give you some life updates. I don't know if you can see it on the screen, but on the floor, I have a yoga mat that extends across my entire office room. And about 75% of the real estate on my floor right now is allocated towards my baby's changing station. I mean, I got diapers, burp cloths all over the floor. And as a first-time father, dude, it's been a crazy journey so far, a roller coaster of emotions, right? I mean, I cry often, right? I'm a pretty sympathetic kind of guy. But I remember when she was born, dude, I had tears in both my eyes. I was like, dude, what in the world? This is insane. This is cool. But it's also like, whoa, I have a +1 in the family now. And so I guess that's my way of saying she was pretty healthy, a little on the small side. And past like 2 weeks now, dude, I've been averaging like 2 to 3 hours of sleep a night. But this past night, I got at least 6.5, 7 hours. And that's why I was like, okay, today's the day where I make a comeback onto YouTube. So I was itching for it, right? I was like, man, I want to create content again. And I just couldn't do it because I was so freaking busy just taking care of the wife, taking care of the baby. But right now, everybody seems to be sleeping. So I think that's one thing as a dad that I'm going to have to take advantage of is the early mornings. When everything is quiet and everyone is sleeping, I think that's when I gotta pound it out and get most of my work done. And having said that, dude, I appreciate all of the love and support. Seriously, I released a video while I was at the hospital, and the overflowing support and love that you guys gave me, man, I'm so freaking happy. I'm so grateful and thankful, and I feel blessed that you guys even choose to watch my videos. So thank you. Thank you for being here. Having said that, I want to give dedicated shout outs. Number one, Matthew. Dude, I appreciate you buying an item from the baby registry. Now that she's here, it's like, man, the baby registry gifts that you guys have been helping us with, so much more tangible. And it's like, wow, we're utilizing it now to do XYZ. So thank you, Matthew. And then number 2, Justin, I want to say thank you so much for giving me that birthday gift and shout out. Yeah, it was my birthday about 4 or 5 days ago. That day was so freaking busy. I was covered in piss, poo, and there was like burp stains all over my shirt. And it was at like 5 or 6 p.m. where I was like, dude, it was actually my birthday. I forgot about it. So thank you for remembering. And having said that, I'll be working on the next set of videos, the best ETF combinations for people with different timelines. Like if you're near retirement, if you are retired, and etc. I feel like this one was allocated towards people that are like 18 up until like 61, 62. Or if you're rich as heck and you're trying to retire at age 30, I guess up to 30. And I know the introduction was kind of long, and that's also because I'm a little rusty. I'm like pent up. I haven't made a video in a while. So the next 3 videos in the series will be straight to the point because this one was long-winded. Now, having said that, I love you guys. Stay safe. Good luck in the stock market, and I will talk to you really soon. Peace.